that everything is lining up. The United States owes $28 trillion in government bonds. This has never happened before. We've talked plus 8 weeks right now. You could argue it already is a default. And this is the largest over-the-counter market in the world for gold. Most of the transactions there are settled in paper rather than physical, but now we're beginning to see a cascade of delivery demands, which very quickly can expose the whole system and or create a run on the vaults, just like a run on the banks, and realizing that there's not enough physical gold there to cover.
You're watching Silver News Daily. Subscribe for more.
The silver market is teetering on the brink of a complete meltdown, and almost nobody is ready for what's coming. Right now, panic buying is sweeping through the market as physical silver supplies run dangerously low. Dealers are running out of inventory, premiums are skyrocketing, and buyers are scrambling, desperate to get their hands on any silver they can find. But here's the twist. While the physical market is on fire, the paper silver market, the one that most people don't even realize exists, is starting to crack. The question is, what happens when the illusion of paper silver can no longer hide the reality of physical shortages? The answer could mean an explosive price surge like we've never seen before. Just think about it. Silver is hovering near $33 an ounce, supported by a surge in safe haven demand amid rising global uncertainties. The U.S. slapping fresh tariffs on automobiles, semiconductors, and pharmaceuticals has rattled markets. Investors are watching the Federal Reserve's next move closely. But beneath the headlines, something far more dangerous is brewing. Physical silver is drying up, and when the paper market crumbles under the weight of the shortage, the price surge could be unstoppable. But is this panic truly justified? Or are we about to witness the greatest silver rally in history? Andy Schectman believes the implosion is imminent. If he's right, silver prices won't just rise, they'll explode. So, what exactly is fueling this panic? And how close are we to seeing silver break through all expectations? Stick around, because by the end of this, you'll know why the smartest investors are preparing right now.
Find out, I don't believe the Exchange Stabilization Fund. I mean, it is opaque, and it is managed by the Department of Treasury, and it's very they don't really talk much about it. It operates very secretly. But its main goal is to stabilize the dollar relative to other currencies. I mean, I guess you could make an argument that that's if the world has lost confidence in the Treasury, the U.S. Treasury bond, that would certainly wreak havoc on the value of the dollar. And it's ironic too, because if I'm not mistaken, I'm fairly certain that it was initially funded with $2 billion in gold loaned by the Federal Reserve. And so could they? I guess they could, largely because everything I've ever read about it says that it lacks transparency. And who knows, if it's run and administered by the Treasury, yeah, absolutely. They could, I suppose, the more that I think about it. Its main objective is to maintain dollar stability. So yeah, I guess why not? You could make that argument that this is something that would be needed. It's an interesting point. I haven't thought about it, but I like it. I wouldn't put it past Trump. And quite frankly, if you think about what would happen if there was complete and total loss of confidence in the treasuries, yeah, that would not be good for the value of the U.S. dollar. So sure, I guess it could be. I don't know how I'd find out, but I can poke around and see.
Physical silver shortages are lighting the fuse on what could become one of the most explosive surges in silver's history. This isn't just a minor supply hiccup, this is a structural problem, and it's sparking panic across the market. Investors who once took silver's availability for granted are now waking up to a harsh reality. The silver they thought was readily available simply isn't there. Demand for physical silver is surging, and the supply just can't keep up. Dealers are reporting empty shelves, premiums are rising fast, and buyers are lining up, fearing they might be left with nothing. But what's driving this sudden scarcity? It starts with industrial demand, massive, relentless, and growing faster than anyone expected. Silver isn't just a precious metal. It's essential for the world's most critical industries. Solar panels, electric vehicles, 5G networks, none of these can function without silver. The solar industry alone now consumes nearly 20% of global silver supply, and this figure is only climbing. China's recent addition of 357 gigawatts of solar and wind power has made one thing clear. Silver's role in renewable energy isn't just important, it's irreplaceable. Unlike other metals, silver's unique conductive properties make it the only viable option for high-efficiency photovoltaic cells. As governments around the world push for cleaner energy, the demand for silver is accelerating at a rate the market simply cannot match. And it doesn't stop there. The electric vehicle revolution is another major drain on silver supply. Silver is critical in every EV's battery, circuit, and electrical connection. With global EV production expected to triple in the next 5 years, this demand shows no signs of slowing down. As silver gets embedded in these products, it doesn't come back into circulation easily. This means less silver is available for investors, further tightening the market. But here's where things get even more alarming. These industrial demands don't pause when prices rise. They don't slow down just because silver is harder to find. These industries need silver, no matter the cost. This dynamic puts investors in direct competition with industrial giants, and when push comes to shove, industry will always win. The result? An inevitable bidding war where prices surge and retail investors are left scrambling. Add to this the fear sparked by geopolitical tensions, such as new US tariffs, and you have the perfect recipe for panic. Investors seeking safe haven assets are piling into silver, compounding the pressure on already strained supplies. The fear of missing out is driving more buyers into the market, pushing premiums higher and inventories lower. The squeeze is real, and it's happening now. So, with physical silver drying up and demand hitting unprecedented levels, what does this mean for the paper silver market? Could it withstand this pressure, or are we heading for a collapse that could send prices soaring? The cracks in the paper market might be the next domino to fall, and when it does, the silver market may never look the same again.
Plus 8 weeks right now, you could argue it already is a default. And this is the largest over-the-counter market in the world for gold. Most of the transactions there are settled in paper rather than physical, but now we're beginning to see a cascade of delivery demands, which very quickly can expose the whole system and or create a run on the vaults, just like a run on the banks, and realizing that there's not enough physical gold there to cover. This has never happened before. We've talked about it on your show for 4 years, but never like this. It was that little by little thing. So is it something that is related to the Basel III Accord, which United States banks, I guess, are going to embrace in July, maybe, which allows them to, call it a tier one asset, at least in terms of their ability to borrow off it against an asset to borrow against with the Fed? I don't know. I don't think it's just that. I think it's something deeper, but whatever it is, it's beginning to really shake things up across the globe as it pertains to the physical gold market and the physical silver market. It hasn't spilled into our reality yet, but it will. And what's really interesting more than anything is the lease rates are spiking. And the lease rates are what are used for players to borrow gold or lease gold in an interim if they don't have the gold that they're supposed to get. It's delayed. There's refining delays. There's supply chain delays. So they would borrow gold or borrow it from or lease it from a bullion bank, as an example. And usually it was just 20, 30 basis points to do so that they could use it to make their jewelry or their bars or whatever they need. They have a contract, let's say a 30-day contract to get that bar. They're paying, not much, might amount to 1% over the life of the contract, but then they get that bar that was delayed and give it back to the party they leased from. Well, these lease rates have spiked to 5, 6, 7% or higher. Same thing, you're seeing the exact same thing on SLV and GLD. The lease rates for the shares to borrow them have gone from 0.5% to 12% in 3 weeks, gone up 24-fold. And the number of shares that you can use to borrow to short the price or the stock has gone in SLV from 10 million to 10,000 in just a few weeks. That's a 99+% reduction. So there's some very interesting things going on that might really lead to a greater price discovery of what gold and silver should actually be priced at, which none of us really know. But I will tell you this, being naked short right now in London must be very frightening. And we haven't seen the end of this yet.
The paper silver market, a system built on promises rather than physical metal, is beginning to show dangerous cracks. For years, this market has given the illusion of abundant silver supply. Traders and institutions have relied on contracts representing silver that, in reality, may not even exist in physical form. But as physical shortages intensify, confidence in these paper promises is eroding. The question is no longer if the paper silver market will collapse. It's when. Let's break it down. The paper silver market operates through futures contracts, exchange-traded funds, ETFs, and other derivative products. These instruments allow traders to speculate on silver's price without ever taking delivery of the physical metal. On the surface, this system seems efficient. But here's the catch. For every ounce of silver physically available, there are dozens, sometimes hundreds, of paper claims. This means that the market is essentially built on leverage, with far more claims on silver than there is metal to back them. This system works as long as confidence holds. But what happens when investors start demanding physical delivery? What happens when the fear of shortages drives them to want the real metal, not just paper promises? That's where the cracks become dangerous. Right now, panic buying in the physical market is exposing this fundamental weakness. As dealers run out of physical silver and premiums surge, more investors are starting to question whether the paper market can fulfill its obligations. The moment enough investors demand physical silver that the market can't deliver, we'll see a short squeeze unlike anything before. And here's where it gets even more precarious. Big financial institutions have been shorting silver for years, keeping prices artificially low. They rely on the fact that most investors never request physical delivery. But as physical shortages mount, these institutions could be forced to cover their short positions, driving prices sharply higher. This creates a feedback loop. The higher the price goes, the more shorts are forced to cover, pushing prices even higher. The parallels to other market crises are striking. In 2008, over-leveraged financial products collapsed when confidence vanished. Could the paper silver market be the next domino? The signs are pointing toward a similar reckoning. With industrial demand surging, physical supplies dwindling, and geopolitical risks rising, the pressure on the paper market is becoming unbearable. If the paper market collapses, the price surge won't just be sharp. It could be historic. The gap between the paper price and the actual cost of physical silver would explode as investors scramble to secure the real metal. Silver wouldn't just rise, it would shatter previous records, potentially changing the entire precious metals landscape. So the question remains, with the paper market on the brink and physical supplies nearly gone, what force could finally push silver into a full-blown squeeze? The answer lies in silver's industrial demand, unrelenting, essential, and growing faster than anyone predicted.
To make prices higher. Yeah, the USPS would have to up their limit. It's crazy, to think of that you can't even send one tube of gold eagles by registered mail unless you have supplemental insurance. It makes it very difficult. We use FedEx with our supplemental insurance. We can assist people in sending things back. But I think we limit it to 125,000 per box. So 2 tubes you could put in. But it wasn't too long ago where, it was 3 and 4 tubes. So USPS registered mail is very secure. It's signed for every step of the way. And it's not something that we typically ever see loss in. But can I just say, it's a pain in the ass. I mean, it really is for people who have never sent it back before through registered mail. It's challenging. You have to seal the box, and then you have to cover all of the seams of the box with postal register tape. And the ironic thing is the post office never has it. They don't sell it. They sell other things on the other side of the counter, but they don't sell register tape. And you can borrow it from them, and they'll give you that look. They'll give you a scissors and this big giant roll and a wet sponge, and you can do it. Or you can go like to a Staples and find the registered tape and do it yourself. But it's a lot of work. But it is the safest way for the average person. The average person cannot take, these to FedEx or UPS and send it. If they know what's in there, they won't insure it. And so it's supplemental insurance that you must have, and that's costly. And Average person isn't going to do it. So the easiest way to send larger amounts back is with our assistance. But um, if you plan on doing this, I would go and preemptively go to Staples and buy a roll of the nylon threaded postal register tape. It would make life much easier for you in the future. You seal the box with strapping tape, and then all of the seams, wherever you could stick an X-Acto knife in, between the seams where they come together, you put the registered tape on it. And then they take their stamp gun and they stamp it all over it to know that it's never been messed with. And anyone who touches it, from the clerk at the window to every single person along the way, has to sign off on it. It's kept under lock and key the whole way. So it is safe, but it's not as easy as one might think.
Silver's industrial demand is the unstoppable fundamentals driving the market toward a critical breaking point. Unlike speculative demand, which can rise and fall with market sentiment, industrial demand is steady, relentless, and non-negotiable. Industries need silver, not as an investment, but as a vital component in products that power the modern world. And this demand isn't just strong, it's surging at levels the market is unprepared for. Let's start with the clean energy revolution. Silver plays a crucial role in solar panels due to its unmatched electrical conductivity. No other metal performs as efficiently in photovoltaic cells. This means as solar energy adoption accelerates, so does the demand for silver. In fact, the solar industry now consumes nearly 20% of the global silver supply, and that number is climbing fast. China, leading the charge in renewable energy, added a staggering 357 gigawatts of solar and wind power in 2024. That's a monumental increase in silver consumption, an industrial appetite that shows no sign of slowing down. But silver's industrial story doesn't end with solar. The electric vehicle (EV) revolution is another massive driver. Each electric vehicle requires silver for its batteries, wiring, and electrical components. With EV production expected to triple by 2030, the strain on silver supplies will intensify. Every new EV rolling off production lines locks away silver in a form that's not easily recyclable. The result? Less silver returning to the market, deepening the already critical shortage. And then there's 5G technology. The rollout of 5G networks worldwide demands silver for its unparalleled conductivity and electronic components. This isn't optional. Silver's unique properties make it irreplaceable in high-performance 5G infrastructure. As the global push for faster, more efficient communication networks grows, so too does the industrial hunger for silver. Here's where things get even more intense. Industrial demand doesn't waver when silver prices rise. While investors might hesitate at higher prices, industries simply pass the costs along or absorb them because they must have silver to function. This creates a dangerous scenario where industrial buyers and investors are competing for a shrinking pool of available silver. As industrial demand drains supply, investors panic, driving prices higher, which in turn pressures industries to secure silver at any cost. A vicious cycle with explosive consequences. Now consider this. As industrial demand soars, available inventories are shrinking. The majority of above-ground silver stocks are essentially unavailable to the market, locked away in forms that won't return to circulation. With such limited accessible supply, any surge in demand can trigger extreme price volatility. This industrial squeeze is unlike anything silver has faced before. Past silver bull runs were often driven by financial uncertainty and investor demand, but this time, the demand is deeply rooted in essential industries powering the global economy. It's not just speculation, it's necessity. So with industries and investors now on a collision course over an increasingly scarce resource, the stage is set for something unprecedented. But industrial demand is only part of the puzzle. There's another major factor quietly pushing silver toward a massive breakout: investor panic, driven by global uncertainties and the race for safe haven assets.
The whole system would blow up. I mean, because it would then realize that we've been lied to all along, and not just on that basic level. I mean, if they tell a lie that egregious for that long, um, then has everything else been a lie too? So, God help us if it's not there. And um, I don't know. Maybe they're scurrying. I don't know. It would be a very big problem. Gold would go parabolic. But that's not all the gold they hold, too. I mean, they have to audit Fort Knox, they have to audit the New York Fed, maybe the West Point Mint. I don't know because it's not all of the gold we hold. It's a lot of it, but not all of it. But it's a good place to start, and it's long overdue. Let's hope it's there. Most people in this industry for a long time has thought it wasn't there. But if he did a live stream and showed everyone and it really wasn't there, it would be very big problems. Gold would go to the moon immediately.
Investor panic is now fanning the flames of an already overheated silver market. As global uncertainties rise, silver's role as a safe haven asset is drawing intense attention. The combination of physical shortages, industrial demand, and geopolitical instability is creating the perfect storm, one where panic buying could push silver prices into uncharted territory. Let's break it down. Investors are rushing to silver because they see what's coming. When uncertainty grips the global economy, smart money flows into hard assets, especially those with both industrial and monetary value. Right now, silver is holding above a crucial support level at $32.53, and bulls are eyeing a breakout above $33.39. But here's the real kicker. These price moves aren't just driven by typical market speculation. They're being fueled by fear. The fear of missing out, the fear of inflation, and the fear that the paper market might not hold. And that fear isn't unfounded. U.S. President Donald Trump's recent announcement of 25% tariffs on auto imports, semiconductors, and pharmaceuticals has sent shockwaves through the markets. Such tariffs threaten global supply chains and raise the specter of economic disruption. When markets feel threatened, investors seek safety. Traditionally, that safety is found in gold, but gold's rally to a record $2,947.08 has brought silver into sharp focus. Investors know that silver historically lags gold, but when it catches up, it does so with explosive speed. This isn't just about tariffs, though. The Federal Reserve's recent policy signals have added fuel to the fire. With interest rates currently held at 4.25%, 4.50%, markets are watching for any sign of a rate cut. Why does this matter for silver? Because lower rates reduce the opportunity cost of holding non-yielding assets like silver. If the Fed turns dovish, silver could break through resistance levels, igniting a rally as investors pile in. Investor psychology is now playing a crucial role. When silver markets tighten, retail investors fear being locked out. This fear creates urgency. Every dip in price becomes a buying opportunity. Every surge validates the panic. As more investors jump in, prices climb higher, creating a self-reinforcing loop of demand and scarcity. But here's what makes the current situation even more precarious. Investor demand is now clashing with industrial necessity. Industrial buyers can't wait for dips. They must secure silver regardless of price. This competition creates a zero-sum game where one side's gain is the other's loss. With physical supplies dwindling, every ounce matters, and investor panic only accelerates the race. This surge in investor demand is not limited to retail buyers. Institutional players are also waking up. As paper silver's reliability comes into question, large funds are moving into physical silver, further tightening the market. This institutional shift has the power to supercharge silver's rally, driving prices beyond traditional resistance levels. So where does all of this leave the market? Investor panic is no longer just a symptom of silver's scarcity. It's becoming a driving force. With safe haven demand soaring, industrial buyers refusing to back down, and the paper market teetering, the silver market is heading toward a critical tipping point. But the panic-buying frenzy and industrial tug-of-war aren't the whole story. There's still a critical aspect of the silver market that could determine how high prices will surge: the truth behind COMEX inventories. Are they the safety net investors believe them to be, or just another illusion ready to collapse?
I read somewhere also that Jamie Dimon was going to sell 1 million shares, or did, or was about to. Again, what does it mean? What does it mean Warren Buffett sells almost all of his Bank of America stock? Does it mean the commercial banking sector is in trouble, or is it something else? I don't know. I think that's one of these deals, unless you really know the inside. Because if I were to guess, just guess, and if there were a reset, like in reading through some of the Nomi Prince did a presentation, and it was about digital ID 2020, and it was about the patents that Visa had on CBDCs in essence, and this kind of stuff. And there were just a couple of the banks that were in the patent, and Citibank, J.P. Morgan, and a couple others, and that's it. I always felt that there would be a few that would survive. I don't know that this means anything other than he's selling and looking to reposition it, maybe, or maybe he feels that we're all of the entire stock market is over leveraged and undercapitalized. Maybe he thinks there's a banking event. I don't know. I mean, I guess it's somewhat ominous, and just as ominous as I felt, and you listen to Gregory Mannarino talking about Bank of America, and at the same time, Ted Butler talked about him for 2 years, and now Warren Buffett is selling the shares. So, maybe there is trouble to be found in the commercial banking area. As over leveraged as they are, that is a doomsday scenario when you realize, again, this is a bank with, I don't know how many trillions, over 100 trillion, I want to say. I could be wrong. I haven't looked at it in a while, but many, 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 many trillions in derivatives. And a bank like that were to go down, the whole system resets just like that. And, is that what they're trying to do? I doubt it, but maybe. Who knows? At this point, I wouldn't put anything by any of the motivations, because like I said, how do you pay 28 trillion in maturing debt in 3 years with tax revenue that amounts to roughly half that, which doesn't account for any of the other operating expenses between now and then? In essence, we're broke. So whatever he does, it's going to be something that I think is radical. And you could argue we're past the point of pussyfooting around. So maybe that's something we should see. And there'll be victims and carnage along the way. If I were being completely honest, I would think J.P. Morgan would slide by that, but I don't know. I don't know at all. I'm sorry.
The COMEX inventories, long perceived as a stable backbone of the silver market, might not be the safety net investors think they are. On paper, these inventories appear to provide a cushion against supply shocks, reassuring investors that there's enough silver to meet rising demand. But what if this belief is based on an illusion? As panic buying escalates and industrial demand tightens the market, the truth about COMEX inventories is becoming harder to ignore, and it could be the trigger for an unprecedented silver surge. Let's pull back the curtain. COMEX inventories are divided into two categories: registered and eligible. Registered silver is available for immediate delivery to fulfill contracts, while eligible silver is simply stored in COMEX-approved facilities, often owned by investors who have no intention of selling. On the surface, total COMEX inventories look substantial. But here's the catch. The majority of this silver is essentially unavailable to the market, regardless of price. This distinction matters because it reveals a critical weakness. When investors or industrial buyers attempt to take physical delivery of silver, they're limited to the registered category. And right now, that pool is shrinking fast. As physical shortages worsen and confidence in paper markets declines, more investors are demanding delivery, draining registered inventories to dangerously low levels. But why aren't eligible inventories stepping in to fill the gap? Because much of this silver is held by long-term investors and institutions that won't sell, regardless of price. These holders view silver as a strategic asset, a hedge against inflation, currency devaluation, and market instability. They're not interested in short-term profits. This means that even as prices rise, these inventories remain locked away, effectively removing them from the market. This dynamic is where the myths begin to crumble. Many believe that as prices surge, all silver will flood the market, but that assumption ignores the reality of above-ground stocks. The recent report from the Silver Institute makes it clear: the majority of above-ground silver stocks are essentially unavailable, no matter how high the price climbs. These stocks include silver, embedded in industrial products, silverware, jewelry, and private hoards, forms of silver that aren't easily or economically recoverable. As more investors become aware of this reality, panic buying accelerates. The belief that there's plenty of silver is replaced by the fear that accessible supplies are running out. This fear feeds into the ongoing rush for physical silver, tightening the market even further. Here's where things get potentially explosive. If COMEX inventories can't meet delivery demands, the entire paper silver market could unravel. Traders and institutions who believed they could settle contracts in cash or roll them over might suddenly face the stark reality of physical delivery requirements. If the registered category is drained, COMEX could be forced to declare a default. Such a scenario would send shockwaves through global markets, obliterating confidence in silver's paper instruments and sending prices soaring as investors scramble for what little physical silver remains. But the implications go even deeper. A COMEX default wouldn't just impact silver traders, it would shake the entire financial system's trust in commodity exchanges. Silver prices wouldn't just climb. They'd spike violently as a global buying frenzy ensued. The silver market would shift overnight from a controlled, paper-driven market to one dictated solely by physical availability. The myths surrounding COMEX inventories have long provided a false sense of security. But as industrial demand remains unyielding, investor panic intensifies, and physical supplies dwindle, this illusion is crumbling. The stage is set for a critical test, one that could redefine the silver market for years to come. Yet, while COMEX inventories teeter on the edge, another silent driver looms in the background: the Federal Reserve's monetary policy. Could the Fed's next move be the final push silver needs to break through every barrier?
This has dominated everything for the most part. There's so many things that have happened in the first month of his administration, but yet we haven't seen the stuff in terms of, how this is going to play out. But this rapid repatriation, it suggests a strategic shift towards monetization. And that's what Scott Bessent said, or something significant. I don't think it's just Basel III, the banks getting their balance sheet, or getting that gold in possession to be in line with the Basel III Accord, where they have to have the physical possession of it. They can't use paper anymore. I don't think it's that. I don't think it's part of it. I don't think it's just tariffs. I don't think it's just covering the naked shorts. That's all part of it. I think it's much deeper than that. And there is a whale that is buying in New York. I mean, a massive whale when you see that kind of volume and that kind of repatriation. And one of the things that I found to be very interesting is, and let me just see if I can find the date before I say this, because I've talked about this. I just want to see if it tells me anywhere the date of when JP Morgan took over GLD. They're the custodian of SLV, but let me just see. Because this is a big deal. It's like all of these things are happening at the same time. Um, well, it's been a little bit longer than I had. They became an additional custodian in in December of 2022. I believe they and BlackRock just became the primary custodian recently. So you have JP Morgan controlling the ETFs, and we're net importers, massive deliveries, the biggest ever, massive deposits, as big as we've ever seen. Something's going down. That's what I would focus on. I mean, more than anything. And it's quiet on the BRICS front. We'll see how that all plays out. Look, you come up with ideas and thesis, and we realize that this is a very fluid world. Had Trump not won, the BRICS would be in overdrive. I don't think that they're backing away from their agenda. I just think they're being very quiet now after what the BIS did to them. I'm watching that. I just think there's a lot happening, and I would like to see how he plans on addressing our fiscal and monetary policies. I would venture to say that it will come out very soon because, the clock is ticking, and midterms are in 2 years. He's got to make these big moves now, before also the rest of the world figures out what he's doing and tries to counteract it. So I don't know exactly how to even answer that question, just to say that the Chinese curse says, may you live in interesting times. Ironically, these are far more fast-paced than it was during the last 4 years, which was the most change we've all ever lived through. This is going to be a different kind of change, a restructuring change, a reset type of environment where the master of bankruptcy and restructuring and the art of the deal, when only 7 or 8 trillion of the nearly 200 is owed to us, or owed to the rest of the world, it's all owed to us. So whatever he had in mind, if the whole thing we're going to reset for us in the United States, it's much easier to do that when a very small amount is owed to the rest of the world, when we can reset on ourselves and restructure here. I know that sounds crazy to even say it, but that's kind of where we're at right now in an environment where confidence and trust has been lost to a large degree. And just because Trump is in office, the people that would normally hold our treasuries have not found renewed confidence. The final chapters have not been written. So I guess
The Federal Reserve, often seen as the ultimate market stabilizer, may soon become the unexpected catalyst that sends silver prices skyrocketing. While investors have been fixated on physical shortages, industrial demand, and COMEX vulnerabilities, the Fed's monetary policy decisions are quietly setting the stage for a massive silver breakout. The connection between central bank policies and silver prices runs deeper than most realize, and right now, every signal from the Fed is pointing toward an explosive silver surge. Let's take a closer look. The Federal Reserve has kept interest rates at 4.25%, 4.50%, adopting a cautious approach in response to inflation concerns and economic uncertainties. Fed policymakers have emphasized the need for more data before making any rate adjustments. But markets aren't buying the wait-and-see stance. Investors are already pricing in at least one rate cut for 2025 with the possibility of a second. And here's why that matters for silver. Lower interest rates reduce the opportunity cost of holding non-yielding assets like silver, making it more attractive. But it's not just about rates. The Fed's broader monetary stance, balancing inflation control against economic slowdown, plays a critical role in shaping market sentiment. Right now, inflation remains above the Fed's target. And although some officials express optimism about disinflation trends, others warn that changes in trade and immigration policies could hinder progress. This uncertainty drives investors towards safe haven assets, and silver, with its dual role as an industrial metal and a store of value, becomes an obvious choice. Recent comments from Federal Reserve Vice Chairman Philip Jefferson further illustrate the point. Jefferson stated that the central bank has time to deliberate on its next move, citing a resilient economy. However, Chicago Fed President Austin Goolsbee added a critical nuance. While inflation has declined, it remains elevated. Goolsbee suggested that interest rates could be lowered once inflation reaches a more acceptable level. Such dovish hints, even subtle ones, fuel market speculation that silver's time is near. Why? Because lower rates mean a weaker US dollar. A weaker dollar typically drives precious metals higher, as it reduces the cost of purchasing metals in other currencies, increasing global demand. Silver, already under pressure from industrial needs and physical shortages, could see demand spike sharply in response. But there's more. The Fed's actions indirectly influence investor psychology. Markets interpret dovish signals as a green light to move into assets that perform well in low-rate environments. Gold has already reacted, surging to a record $2,947.08. Historically, silver follows gold's lead, but not passively. When silver moves, it does so with explosive speed, often outpacing gold's gains. Investors know this pattern, and as the Fed inches closer to rate cuts, they're preparing for silver's inevitable breakout. Additionally, global monetary policies are converging. Central banks worldwide, facing similar inflationary pressures, are adopting dovish stances. This synchronized approach amplifies silver's appeal. As fiat currencies weaken collectively, silver's intrinsic value shines brighter, attracting both institutional and retail investors. But the Fed's influence isn't purely psychological. Its policies directly impact liquidity in the financial system. Lower rates and potential quantitative easing measures flood markets with capital. This excess liquidity often finds its way into commodities, particularly those with bullish fundamentals. With silver's physical market already stretched, additional demand driven by easy monetary conditions could push prices beyond previous highs. The looming question now is, how will silver respond if the Fed pivots sooner than expected? Will a rate cut unleash the pent-up demand that finally breaks silver's long-standing resistance levels? The answer may come sooner than most expect. Yet even as the Fed's policies quietly build pressure under silver's price, another factor could act as the immediate spark: gold's relentless surge. History shows that when gold breaks records, silver doesn't just follow, it explodes.
Um, you know, logarithmic decay just is basically it's a theory that's it's like being on Niagara Falls, and you notice the pitch falling little by little by little by little, then bang all at once. It you can during the Biden administration, almost everything I saw around me, I could make an analogy with logarithmic decay. But in terms of maybe the LBMA, for a long time now, we've seen little by little the draining of the exchanges, little by little, and it's accelerating. Now, heaven forbid we see that all at once moment where the whole thing blows up. But there are a lot of things that you can contribute, or you can draw that analogy between what's happening um, with society and, like for example, in 2020, we started to see rumblings of censorship and things you couldn't say or shouldn't say. And it got worse and worse and worse. And bang, now it's everywhere. And people were getting deplatformed and they were getting, suspended from schools. And in the UK, they're arresting people for doing that. So, I mean, you could argue that whole phenomenon started out very slowly and then got more and more and more rapidly till it was everywhere in your face and part of just society, part of the fabric. Let's hope those kind of things reverse. But yeah, logarithmic decay, especially as it pertains to, you could say, the public's awareness and accumulation of metal, little by little by little, then bang, something happens and everyone wants it and it's too hard to get. So yeah, logarithmic decay explains a lot to me. And it's pervasive, and I think it will explain a lot in terms of the draining of the exchanges, the people in this country's understanding and acceptance of gold and silver as an important part of their portfolio. There will be an all-at-once awakening, and unfortunately, that usually is associated with some sort of an event.
Gold's record-breaking surge is casting a long shadow, and silver is poised to break free with explosive force. Historically, when gold takes the lead in a bull market, silver doesn't just follow. It surges past expectations with aggressive momentum. Right now, gold has hit a record $2,947.08, sending a clear signal that precious metals are back in the spotlight. But here's the crucial part. Silver, currently trading just under $33, remains vastly undervalued compared to gold. And when silver finally catches up, the rally could be far more dramatic than anything we've seen before. Let's explore the dynamic between these two metals. The gold-silver ratio, a key indicator that investors use to determine silver's relative value, is flashing a massive buy signal. This ratio measures how many ounces of silver are needed to buy 1 ounce of gold. Historically, when this ratio reaches extreme levels, silver rallies aggressively as the market corrects the imbalance. With gold already pushing all-time highs and silver still lagging far below its historical peak of nearly $50 an ounce, the gap is wider than it should be. And history shows that silver doesn't like to stay undervalued for long. Think back to 1980. Gold soared, but silver's response was even more spectacular. Silver rocketed from under $6 to nearly $50 in a matter of months. Then in 2011, as gold broke past $1,900, silver surged from $9 to almost $50, delivering gains of over 400%. In both cases, silver didn't just play catch-up, it overperformed, delivering massive returns in a short period. Now consider today's environment. Gold's surge is driven by global economic uncertainty, inflation fears, and central bank buying. These are the exact conditions under which silver typically outpaces gold. The question isn't whether silver will follow gold, it's how high it will go when it does. But there's an additional factor this time around: silver's industrial demand. Unlike past rallies, silver's surge today won't be driven solely by investor speculation. The clean energy revolution, electric vehicles, and 5G technology are all driving unprecedented industrial demand. This demand doesn't slow down when prices rise. In fact, it intensifies the squeeze as industries are forced to compete with investors for limited supply. And here's where things get potentially explosive. If gold maintains its momentum and challenges the $3,000 mark, silver could break through key resistance levels almost overnight. Traders are watching for a breakout above $33.39, which could trigger a rapid acceleration toward $34.87 and beyond. If this happens, silver won't just rise steadily. It could launch into a parabolic rally driven by panic buying, industrial shortages, and institutional inflows. Investor psychology will play a massive role. As silver breaks resistance levels, fear of missing out will kick in. Retail investors will rush in, pushing prices higher. Institutional players, seeing the potential for outsized returns, will deploy capital into silver and silver-related assets. The market will shift from a slow grind to a rapid ascent, with each new high attracting more buyers. Gold's rally also creates a critical perception shift. When gold breaks records, it legitimizes the precious metals market in the eyes of mainstream investors. Silver, being more affordable, becomes the next logical choice. This accessibility factor means that when retail investors pour into the market, the impact on silver prices is far more pronounced. But the gold-silver dynamic isn't just about historical patterns or investor psychology, it's about market mechanics. As silver's price rises, short sellers could be forced to cover their positions, adding fuel to the rally. This short squeeze could push prices to levels that seem impossible today. With gold setting new records and silver's fundamentals stronger than ever, the market is primed for a historic silver rally. But while gold's surge provides the perfect tailwind, the silver market is still missing one final piece: the convergence of all these forces into a singular explosive event. And that convergence is closer than you think. Because all these threads, physical shortages, industrial demand, COMEX vulnerabilities, investor panic, and Fed policy, are leading to one inevitable conclusion: the silver supernova.
For some form of monetization of the gold market. And if nothing else, a much more accentuated awareness of gold and of silver. So my hope is that that permeates. Now, if that does permeate into the general public, I would say that you will see what has amounted to the best buyer's market I've ever seen in my career. That changes on the drop of a hat, because as much product overhang as there is right now, et cetera, with these kinds of events that could very quickly motivate people, that changes in the drop of an eye. And I'm dead serious. It is the best opportunity to buy gold numismatics I've ever seen in my career. Never have I seen this. Semi-numismatics up to 64, 65 grade. If you've ever thought about doing it or trading bullion for it, as God is my witness, I have never seen a more advantageous time. I've done it with a lot of my own bullion. And to me, it's just one of these deals where there's virtually no downside. So no, that didn't answer your question. I don't know, man. My brain hurts. There's so much going on, but I'll be paying attention. And if there's something big, we'll talk.
Awesome. Andy, thank you so much. And folks, it's because of you that we're even here. Every single one of you is a leader, because you're taking a step that 99.5% of the population hasn't taken. That's to unplug from the mainstream financial media and get some real information for a change. Good for you. You can help out by subscribing. If you haven't, make sure you click the subscribe button. You can also get on our free mailing list, costs nothing, and we don't share your information with anyone. It's completely private. Go ahead to libertyandfinance.com, put in your email address, click submit, and confirm on the confirming email. You'll get one email in your inbox per day with all of our interviews with Andy and all of our other guests, and all of Andy's weekly specials will be in there as well. That's it. One email per day. You'll be up to date. So Andy, as always, thank you for joining us here on Liberty and Finance.
Last question. When's your interview with Judy Shelton?
Monday. It's when I talk to her here on Liberty and Finance. It'll either come up Monday night or Tuesday night next week, we hope.
Well, say hi for me. I can't wait to see it. And you're the best, and again, we'll see you next week.
Thank you, Andy. Thank you, everyone else, for being here. God bless all of you and your
God
families.
bless. No,
Everything is converging: the physical shortages tightening supply chains, relentless industrial demand draining inventories, a paper-silver market teetering on collapse, investor panic intensifying with each headline, COMEX inventories revealing more illusion than substance. dovish signals from the Federal Reserve hinting at a weaker dollar, and gold's historic surge dragging silver toward its own breakout. All these forces are aligning at this moment. The silver market isn't just poised for a rally, it's standing on the brink of a supernova. When silver moves, it moves fast, and violently. History shows that silver doesn't simply rise, it slingshots. And this time, the stage is set for the most explosive surge yet. Industrial sectors can't wait for dips. They must secure silver at any cost. Investors, fearing scarcity, are snapping up physical silver, driving premiums to record levels. Meanwhile, the paper market's thin veneer of confidence is cracking as delivery demands threaten to expose years of overleverage. Gold's record run above $2,947 isn't just a headline. It's a signal. Silver follows gold, but with a ferocity that leaves markets stunned. A breakout above $33.39 could ignite a rush toward $34.87, with institutional capital, retail investors, and industrial buyers all piling in, creating a feedback loop that pushes silver higher and higher. But here's the reality. When the silver supernova hits, it will be swift and unforgiving. Those waiting for the perfect entry point will be left chasing a runaway market. The window to act is narrow, and once silver breaks its long-standing resistance levels, the acceleration could be historic. If you're watching the signs, physical shortages, Fed policy shifts, industrial demand spikes, and investor panic, then you know what's coming. The forces are too strong, the pressure's too great. The silver supernova isn't just possible, it's inevitable. So the question is, will you be ready when it happens? Make sure you subscribe for more insights like this so you don't miss a single move in the silver market. And remember, this is not financial advice. Always consult with a qualified financial professional before making any investment decisions.